14 of 21 series are aligned with STAGFLATION mild this morning. That is a moderate level of agreement across the engine's 21 series, enough to say the math is coherently describing a stagflationary backdrop rather than a fragmented or transitional state. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. In this macro regime, the framework is tracking growth momentum decelerating at -0.5777 and inflation momentum accelerating at +0.0081, a configuration where economic activity softens even as price pressures stay firm. The coherence score is in a moderate zone, which for us means the 21 series do not all point in the same direction, but a clear majority tilt toward this stagflationary profile. By our historical math, a confirmation score in this range for stagflation mild has persisted in roughly 41% of comparable 3-month windows, with the most frequently observed next configuration being an acceleration regime, an environment where both growth and inflation momentum speed up together. Compared to a month ago, the confirmation score is stabilized at 14 after earlier tests toward lower alignment, while growth momentum has become more negative and inflation momentum has edged higher. Historically, environments like this have often felt range-bound at the index level, with more dispersion beneath the surface and a tendency for defensive assets and real assets to hold their ground more often than not, a description of recorded past behavior, not a forecast. Across individual signals, long-term yields and rate volatility form the first anchor. The 10-year Treasury yield remains below the 4.45% threshold that the engine watches, while the Treasury volatility gauge, MOVE, is sitting in a low single-digit percentile relative to its last 2 years, indicating compressed rate volatility. In the framework's terms, that volatility configuration reads as green, defined quantitatively as declining or subdued volatility relative to its own history over the look-back window. Investors watch these measures because they shape discount rates, mortgage costs, and the hurdle rate for risk assets. The question this raises is whether calm in rates reduces the perceived cost of holding risk, or instead reflects complacency around macro uncertainty. In our framework's reading of comparable periods, this roughly coincided with more orderly cross-asset trading and a greater role for idiosyncratic news in driving moves over the following several weeks. An observation under our methodology, not a forecast. What would challenge this read is a renewed spike in rate volatility or a decisive break higher in long yields through key triggers that reprice the cost of capital. Labor conditions provide a second contrasting signal. Non-farm payrolls and related employment gauges that sit inside our weekly economic index have cooled, and one of the engine's red flags is assigned to payroll momentum, defined as a negative rate of change over the observation window rather than an absolute jobs decline. Investors monitor payrolls because they anchor household income, default risk, and the breadth of demand across the economy. The core question is whether slower hiring changes how much duration in risk assets or leverage feels comfortable to carry. In our framework's reading of comparable periods, this roughly coincided with a tilt toward weaker performance in cyclically sensitive sectors versus defensive groups over 1 to 3 months, an observation under our methodology, not a forecast. What would challenge that characterization? A renewed acceleration in hiring and improvement in leading labor indicators, such as jobless claims, that mathematically turn the momentum label back toward neutral or green. Credit spreads are the third major signal. High-yield credit spreads, the extra compensation investors demand for owning lower-rated corporate bonds, are marked red in the engine, meaning spreads have been widening on a rate of change basis even if levels remain below prior stress peaks. That red tag is defined as spreads moving higher and doing so faster than their own trailing average. Markets watch this closely because it tells them how much pressure is building under corporate balance sheets and refinancing. The key question is whether this quiet widening challenges the pricing of equities, private credit, or leverage strategies, or whether it simply reflects a modest repricing of risk. In our framework's reading of comparable periods, this roughly coincided with more uneven equity performance, greater dispersion across credit quality, and episodes of risk-off behavior within subsequent weeks, an observation under our methodology, not a forecast. A meaningful tightening in spreads, or stabilization that flattens the rate of change, would challenge the current red reading. Finally, sector rotation across equities sits at the nexus of these macro forces. Technology and energy sectors finished higher, while financials, materials, industrials, healthcare, real estate, and utilities all closed lower, with materials and financials seeing the softest performance. Gold futures were stronger overnight, even as a broad gold equity fund finished lower, and long-duration treasury bonds slipped. In the engine's language, this is a mixed configuration. Some growth and commodity-sensitive groups on the upside, many cyclicals and rate-sensitive areas under pressure. Investors track this because sector leadership often tells them how the market is digesting macro conditions, from funding costs to inflation and growth expectations. The question is whether this split encourages a barbell approach between growth and real assets, or prompts a reassessment of broad equity exposure. In our framework's reading of comparable periods, this roughly coincided with choppier, range-bound index performance and more pronounced relative moves between sectors over multi-week windows, an observation under our methodology, not a forecast. A shift toward broad-based sector strength or synchronized weakness would challenge this mixed profile. The conditional map adds structure around key levels the engine monitors. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, the inflation composite showed acceleration in roughly 9 of 11 comparable conditions. A historical characterization, not a forecast. In regime terms, the engine has seen that type of rate move coincide, in the sample, with a stronger mathematical case for transitions toward acceleration regimes where both growth and inflation momentum pick up. If the fear and greed index drops below 15 and holds there for 5 consecutive sessions, in our framework's reading, the confirmation score deteriorated in roughly 7 of 9 comparable conditions. Again, a historical characterization, not a forecast. Within the regime lens, prior episodes of such extreme risk aversion have tended to coincide with lower coherence around the prevailing regime and more frequent regime watch flags. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. That use of Atlas is inherently potential, and educational, a structured way to learn from how the 21 series and the 407 symbols have behaved across different configurations in the historical record. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.